Let's begin by talking about something I believe every one of us has faced at some point: the most common mistakes in trading. And I want to make this clear from the start. This is not about blaming anyone. I have made most of these mistakes myself. In fact, almost everyone who has ever traded has gone through them. This is completely normal. But here is the key point. Once we understand why these mistakes happen, once we recognize what is really going on beneath the surface, fixing them becomes much easier. And just to give you some context, if you look at CFD and Forex brokers that are legally required to publish their data, somewhere between 74 and 79% of retail accounts lose money. That is not an opinion. It is documented regulatory data, so this is not a rare issue. We are talking about something that affects the vast majority of traders. Welcome to the ComLucro channel. Today, we are going to explore why this happens. So here is the plan. We will walk through 5 groups of mistakes that keep showing up, not only in my own trading, but also in research data and in the experience of traders around the world. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, the first group has nothing to do with charts or strategies. It is about our brains and how they are naturally wired against us in a trading environment. Then we will explore the psychological traps that pull us in, the behavior patterns that drain our accounts, and even how the trading environment itself is designed to push us in the wrong direction. And finally, we will cover something that may sound a bit dry, but is honestly one of the most important pieces of the puzzle: position sizing. By the end of this video, I will also share what I have personally been doing to improve in these areas. But before that, we need to understand the root causes, because once we see the full picture, the solutions start to make sense naturally. So, let's begin with the point that surprised me the most. Here is something most people never think about: our brains, the actual system behind every decision we make. We are not designed for trading. Our brains were built for survival, to run from danger, find food, and avoid threats. And that may sound like something from the distant past, right? But the problem is that when we enter a trade and it moves against us, especially with real money and leverage involved, our brain reacts to that loss in a way that is very similar to how it would respond to a physical threat. Of course, the real neuroscience is far more complex, but in simple terms, our emotional responses tend to override our logical thinking under financial stress, and that alone is enough to disrupt our decision-making. Have you ever seen a trade go against you, and suddenly your entire plan disappears? You freeze or panic and end up selling at the worst possible moment. That is not weakness. That is your brain doing exactly what it was designed to do, protecting you from what it perceives as a threat. And here's something interesting. Brain studies have shown that experienced traders process risk in a very different way. Their brains adapt through repeated exposure. The fear is still there, but it no longer takes control of their decisions the same way it does for someone new to trading. So the first thing to understand is this: your brain is not broken. It is simply running old programming in a modern environment. And once you realize that, you stop blaming yourself for emotional reactions, because everyone experiences them. It's part of being human. But this is only the first layer, because on top of this biological wiring, there is an entire set of psychological traps waiting for us. So now that we understand the brain is wired for survival, let's look at how that actually impacts our trading decisions, because this is where things become very relatable. There is a concept in behavioral economics called loss aversion. And what research consistently shows is this: the pain of losing money is roughly twice as strong as the pleasure of gaining the same amount. So losing $100 hurts much more than gaining $100 feels good. Now think about what that does to our trading behavior. Imagine we make $200 on one trade. That feels good, right? But then we lose $200 on the next trade. Even though we are back at break-even, it does not feel like break-even. It feels like a loss. And this imbalance shapes everything. When we are in a winning trade, we become anxious. We want to secure that profit before it disappears. so we close the trade too early. But when we are in a losing trade, we hold on. We tell ourselves it will come back. We wait for break-even because closing the trade means accepting a real loss, and this is not just theory. It is one of the most well-documented behaviors in trading. We cut our winners short and let our losers run. Almost everyone does this at some point, and it gets even worse, because when the market continues to move against us while we are holding a losing position, our brain starts playing tricks on us. It begins searching for information that confirms we are right. We ignore what the price is actually doing. We scroll through social media, looking for someone, anyone, who agrees with our idea. And before we realize it, we start averaging down, adding more money into a losing trade that is already underwater. If this sounds familiar, do not worry. We have all experienced it. But this behavior does not stop there. It leads into something even more destructive. So our brain is wired for fear, and our psychology pushes us to hold losers while cutting winners. That is already a difficult combination. But on top of that, we add behavior. And this is where things can really start to spiral. Let's begin with FOMO, the fear of missing out. We see a strong move happening. Maybe a stock or a coin just jumped 30%. And even though we had no plan to trade it, even though it was never part of our setup, we jump in because missing the move feels worse than the risk of a bad entry. The problem with FOMO trades is that they almost always happen at the worst possible moment. We are buying after the move has already occurred. We enter with no plan, no stop loss, driven purely by emotion. And more often than not, we end up on the wrong side of the trade, buying at extended prices while others are already taking profits. Now, when a FOMO trade goes wrong, or even when any trade goes wrong, something even more dangerous can follow. Revenge trading. We feel like the market has wronged us. We want our money back. So we increase our size on the next trade, skip the analysis, and jump into another position, trying to recover immediately. And revenge trading almost never works, because we are no longer acting from logic. We are acting from emotion. One bad trade turns into 2, then into 3, and before we realize it, our account is down significantly. Not because the strategy failed, but because we stopped following it. And I believe many of us have been in that situation, staring at a losing trade late at night, telling ourselves it will come back. It does not. And instead of closing it and going to sleep, we open another trade, trying to recover before the morning. And in just a few hours, we lose more than we did during the entire previous week. That is when it becomes clear. The damage is not coming from the market. It is coming from how we react to the market. Now here's the part most people do not talk about. All of these behaviors, FOMO, overtrading, revenge trading, they are not personal flaws. They are predictable responses. Once we recognize them, we can prepare for them. At that shift alone, moving from reacting to anticipating changes everything. So far, we have been looking at what is happening internally, our brain, our psychology, our behavior. But there is also something happening externally that we need to understand. Modern trading platforms are intentionally designed to keep us trading. Push notifications about trending assets, top movers, tabs, confetti, and animations when we execute a trade. These are not neutral features. Research has shown that these design elements can increase trading activity by more than 5%. They trigger the same dopamine loops as social media and even slot machines. And then we have social media itself. Financial influencers sharing their wins, their calls, and their predictions. And when we see someone we follow making a confident call, it becomes very difficult not to act on it. Even when we know that most of these calls do not include proper risk management, position sizing, or any follow-up when they're wrong. And here's what the data shows. When retail traders rush into a stock driven by influencer hype, they usually end up buying at the worst possible moment, when the price is already extended. Early participants take profits, and late entrants absorb the losses when the price corrects. Now, this is not about blaming anyone or seeing ourselves as victims. It is about awareness. When we understand that these forces exist, we can make deliberate decisions instead of reactive ones. So we have biology working against us, psychology pulling us in the wrong direction, behavior patterns compounding the problem, and an environment that amplifies all of it. That is a lot. But here is the good news. Once we see the full picture, we can actually start to fix it. And it begins with something surprisingly simple, yet often overlooked. Let me be honest with you. This next part may be the least exciting section of the video. It is about numbers, percentages, and basic math. But if there is one part of this video that can truly protect your trading account, it is this one. Let's talk about position sizing. Because most traders, when they take a position, focus on the entry, the setup, the indicator, or the pattern. But the amount they risk is treated almost as an afterthought, and that is where the real damage happens. Think about it this way. Imagine we have a $25,000 account and we follow a simple rule. Never risk more than 2% on a single trade. 2% of $25,000 is $500. That means we would need to lose 50 trades in a row. 50 consecutive losses to completely wipe out the account. That gives us a huge margin for error. But without that rule, if we are risking 10% per trade, just a sequence of 5 or 6 losing trades can cut the account by more than half. And now we would need to double what remains just to get back to the starting point. The math behind drawdowns is unforgiving, but there is a smarter way to approach this, by adjusting position size based on market volatility. So, the idea is simple. When volatility is high, we reduce our position size. When the market is calm, we can increase it slightly. This way, the actual dollar risk remains consistent no matter what the market is doing. It is similar to adjusting your speed depending on the road conditions. Now, I understand this may sound simple, maybe even a bit boring, and I'm not trying to oversimplify it. Risk management alone does not guarantee success, but without it, failure becomes very likely. The traders who last long enough to become consistently profitable did not survive because they had the best strategy. They survived because they prioritized risk management. So now that we have covered the 5 key areas, brain, psychology, behavior, environment, and position sizing, the real question becomes, what do we actually do with all of this? We have gone through a lot so far. We have seen how our brain can work against us, how psychology pulls us into traps, how our behavior amplifies mistakes, how the environment is designed to take advantage of it, and why position sizing is more important than most people think. So what can we actually do moving forward? Here is what I have found helpful. And just to be clear, I am still working on all of this myself. This is not a lecture. It is simply what I have observed to make a real difference. The first step is becoming aware of our own psychology, and one of the simplest ways to do that is through journaling. Not just recording trade details like entry, exit, and profit or loss, but also tracking your emotional state. How did you feel before entering the trade? Were you calm or were you chasing the market? Was this part of a planned setup or was it an impulsive decision? Think back to the cognitive dissonance we discussed earlier, where the brain selectively looks for information to confirm we are right. Journaling is one of the most effective ways to counter that. As you start tracking your emotions, patterns begin to appear quickly. And once you recognize those patterns, you can start interrupting them. The second step is having a clear method and staying consistent with it. Whether you use price action, indicators, order flow, or any other approach that works for you, choose one. Test it enough so that you trust it, and then execute it consistently. Avoid switching strategies every week or jumping from one indicator to another. Consistency, even when it feels repetitive, is what produces results. The third step, and the one that has made the biggest difference for me, is accepting that any single trade can go either way. We will never know the outcome of an individual trade in advance. But over 50, 100, or 200 trades, a solid method combined with proper risk management begins to show its edge. So instead of trying to predict each trade, we stop taking losses personally. We focus on execution, manage our risk, and allow the probabilities to play out over time. That shift, from trying to be right on every trade to trusting a process over many trades, has been one of the most meaningful changes I have experienced. And it did not require any secret strategy. It simply required letting go of the need to be right every time. This is what I wanted to share from the beginning. Now, some of these ideas may sound familiar, and they probably are, because much of this knowledge comes from experienced traders and psychologists like Mark Douglas, known for trading in the zone, Tom Hugard, David Paul, Brett Steenbarger, known for the daily trading coach, and Alexander Elder, known for trading for a living, as well as from educational videos, including some we have already shared here on the channel from other well-known trading psychology experts. But the difference now is that we understand why they work. It is no longer just generic advice. It directly addresses the biases and behavior patterns we have been discussing. The concepts are not complicated, but they are difficult to apply because they require changing habits that our brain naturally resists. Now, if you're watching this and thinking it might be too late because you have already blown an account or you are currently in a deep drawdown, I want to say this: it happens. It happens to many traders. And the most important thing right now is not the money that is gone, but what you choose to do next. From what I have seen, traders who recover from blown accounts usually follow a similar path. First, they stop. They take a break and allow their mind to return to a calm and rational state. Second, when they come back, they trade with very small position sizes, much smaller than before. The goal is not to recover the losses immediately. The goal is to rebuild confidence and prove that they can follow a structured process. And this may sound counterintuitive, but many well-known traders experienced blown accounts before becoming consistent. Now, not everyone who blows an account comes back stronger. That is the reality. But those who do almost always point to the same turning point. They finally took risk management seriously in a way they had not before. So if that is where you are right now, it is not the end. You are simply at the stage where most people give up, and those who keep going often come out stronger on the other side. So to wrap everything up, today we covered the 5 main areas where most mistakes happen: our brain and its survival wiring, psychological traps, behavioral patterns, the trading environment, and position sizing. The takeaway is not that trading is impossible or that failure is inevitable. The takeaway is that these mistakes are predictable. They have clear causes, and once we understand them, we have a real opportunity to approach trading differently. We do not need to be perfect. We just need to stay aware. Every time we catch ourselves about to repeat one of these mistakes, even if we still make it, that awareness is progress. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.